Welcome to The Explainer. Okay, I am absolutely pumped for this one. Today, we're putting on our expert investment analyst hats to run a high-stakes valuation stress test on a genuinely fascinating biotech anomaly. We're looking at Aurinia Pharmaceuticals, ticker symbol AUPH. This is one of those rare stocks where the market's narrative is just completely at war with the underlying financials. To figure out who is actually right here, we're going to run this company through a relentless, multi-model gauntlet. We'll extract the data, calculate the exact math, and see if this is a massive value trap or literally the opportunity of a lifetime. Let's get into it.
Here is our roadmap for today. We've got the snapshot and Buffett lens, the Peter Lynch lens, the Benjamin Graham lens, our DCF valuation analysis, alternative valuation models, and finally our synthesis and final recommendation.
Section 1. Snapshot and Buffett lens, a quality assessment.
All right, let's look at the setup. Aurinia is a commercial-stage biopharmaceutical company, and their big claim to fame is LUPKYNIS. That's the very first FDA-approved oral therapy for adult patients with active lupus nephritis. Now, what's really interesting here and what caught our eye in the first place is the massive valuation disconnect. The stock is sitting at around $15.78 per share, which gives it a $2.1 billion market cap. But here's the kicker. Despite having a highly successful flagship drug that generates 90% gross margins and prints serious cash, the market is pricing this entire company at just 5 times its guided 2026 sales. That is an incredibly depressed multiple for a profitable commercial biotech.
So, would Warren Buffett bite? Let's run it through his quality criteria. Surprisingly, Aurinia passes with flying colors. First up, the economic moat. LUPKYNIS has very high clinical switching costs. Older generic therapies for lupus nephritis are super volatile. They require constant blood monitoring. But LUPKYNIS is predictable. It stabilizes the kidneys. Because of that, nephrologists are incredibly hesitant to take a stabilized patient off of it. That gives Aurinia incredibly sticky, recurring revenue. Second, management. The chair and new CEO, Kevin Tang, takes literally zero compensation. No salary, no bonuses. His reward is 100% tied to the stock going up. Third, earnings consistency is stellar, with a recent 90% spike in operating income. And finally, debt? Absolute zero. Plus, they are sitting on a massive buffer of nearly $379 million in cash.
But you know, Buffett, he doesn't just look at the qualitative stuff. He zeroes in on owner earnings. Now, if we look at their trailing 12-month profit, it looks artificially massive. Why? Because in late 2025, they released a $173 million one-time tax valuation allowance. To be good conservative analysts, we absolutely have to strip that out. When we remove that one-time tax benefit, we find a true normalized owner earnings run rate of roughly $130.4 million annualized. That's based on their phenomenal Q1 operating cash flow and income. Based on this robust cash flow generation and that strong moat we talked about, Buffett would likely see intrinsic value well above current prices, probably seeking an entry below $20 just to lock in a comfortable margin of safety.
Section 2. The Peter Lynch lens, growth versus asset play.
If Peter Lynch looked at Aurinia, he'd see a really unusual, rare hybrid. On one hand, it's a classic fast grower. In Q1 2026, total revenue reached $77.7 million. That's a massive 24.4% year-over-year increase. But on the other hand, it's priced like a deep value asset play. Between their massive $378 million cash pile and their recent strategic acquisition of Kezar Life Sciences, which by the way brought a multi-billion-dollar autoimmune drug called zetomipzom into their pipeline, the market is effectively valuing all of their future pipeline research at absolute zero.
So the magic number for Lynch is the PEG ratio. The PEG ratio takes the price-to-earnings ratio and divides it by the growth rate. Generally speaking, a PEG under 1.0 indicates severe undervaluation. So let's do the math. If we take Aurinia's normalized trailing earnings, giving them a PE of roughly 15, and we divide that by their phenomenal 24% revenue growth rate, Aurinia's PEG sits at a staggering 0.62. For a Peter Lynch disciple, finding a PEG of 0.62 on a cash-printing, high-margin business, that is an absolute screaming buy signal.
Now, if that PEG didn't convince Lynch, this insider activity absolutely would. Lynch famously said that insiders might sell their stock for any number of reasons, but they buy them for only one. They think the price is going up. CEO Kevin Tang, who, remember, takes zero base salary, just went out and purchased 815,000 shares on the open market through his affiliated funds. That is a $12.5 million personal bet on this company's future.
For Lynch, finding low institutional hype combined with massive insider buying is practically the holy grail. Section 3. The Benjamin Graham Lens, Deep Value Test.
Now, let's strip away the growth narrative entirely and look at this through Benjamin Graham's eyes. Graham's checklist acts as a strict pass-fail test for the defensive investor. Looking at the board, Aurinia passes on adequate size with a $2.1 billion market cap, and they easily pass on financial condition with zero debt and a strong current ratio. However, it fails the rest of his strict criteria. Aurinia has a history of unprofitability prior to this recent inflection point. They pay zero dividends, and because it's trading at roughly 3.5 times its book value, it completely fails Graham's requirement for a moderate price-to-book ratio.
Let's actually crunch the numbers on Graham's legendary intrinsic value formula, the square root of 22.5 times earnings per share times book value per share. Using our normalized EPS of $1.04 and their book value per share of $4.39, the formula spits out an intrinsic value of exactly $10.13. So what does this mean? It means at the current price of $15.78, Graham would warn there is absolutely zero margin of safety here. None. He would categorically avoid this stock until it dropped down near $10.
Section 4. DCF Valuation Analysis, Discounted Cash Flows.
All right, stepping away from the classic gurus, let's build a modern, base case, discounted cash flow model. To make this reliable, we have to price in the market's biggest fear, the pending New Jersey patent litigation. Generic manufacturers are currently trying to invalidate Aurinia's 2037 dosing patents. To be highly conservative here, we're using an 11% weighted average cost of capital, which is essentially a strict risk hurdle rate for biotechs to discount the cash flows. We're also assigning a harsh 0% terminal growth rate to heavily penalize the model for that looming patent cliff risk. But here's the crazy part. Even with these extremely conservative assumptions, forecasting steady free cash flow from LUPKYNIS still gets us to a base fair value of $19.50 per share.
This sensitivity table is absolutely fascinating because it perfectly maps out the tension in the stock right now. Look at this. If generic competition enters early, shifting our terminal growth to -2% and our risk premium up to 12%, the fair value plummets toward $15. That is right where the stock is trading today. But if their newly acquired pipeline actually succeeds, pushing terminal growth to just a modest positive 2%, fair value rockets past $22.50 all the way to $25. So the takeaway here is that the market is currently pricing in the absolute worst-case scenario as a 100% certainty.
Section 5. Alternative Valuation Models, Cross-Referencing Data.
To make sure our DCF isn't totally out in left field, we need to cross-reference it against alternative institutional frameworks. A reverse DCF implies the market expects virtually no growth. Meanwhile, the Trefis analysis pegs fair value at $17, relying heavily on a compelling 8% free cash flow yield and a 14% total earnings yield. Then, if we look at a probability blended model, which factors in a 25% chance of massive pipeline success and margin expansion to 40%, we get a blended consensus target of $24.40.
Section 6. Synthesis and Final Recommendation. The Final Analysis.
Okay, we have run the gauntlet. Here is our ultimate scorecard. Benjamin Graham hates the lack of hard historical asset protection, so his model screams sell. But Buffett, he respects the high-margin cash flow and the clinical moat. Lynch is screaming strong buy based on extreme insider alignment and that wonderfully depressed PEG ratio. And our modern DCF and blended model suggests the stock is significantly undervalued right now, even when we explicitly price in severe patent risks.
So, taking all of these models together, our final expert verdict is a cautiously optimistic buy. The company is printing cash today and management is fully aligned with shareholders. But it leaves you with this really provocative dilemma. Are the New Jersey patent risks already fully priced into this $15 stock, essentially handing you a massive multi-billion-dollar autoimmune pipeline for completely free? Or is this just a classic agonizing courtroom value trap? That is the ultimate question you have to answer for yourself. Thank you so much for joining me on this explainer, and as always, keep your eyes on the data.